Hi, good afternoon, everyone. Thank you for joining us today. My name is Carrie Simpson. I am the founder of Managed Sales Pros and a partner at Richardson and Richardson. I'm joined today by Ian Richardson, the founding or managing partner of Richardson and Richardson, Christopher Vollmond-Carstens from Ntiva, and Jay Cook from AAI Financial. And we are on part 4 of our MSP Exit series. Today, we're going to be learning about due diligence and the documentation that you're going to need to produce before and after an LOI. And hopefully that gives everybody an understanding of how much work is involved in preparing your business for sale. You can begin doing that work right away so that you don't have to scramble for it when the right offer presents itself. Some housekeeping today. On the right-hand side of your screen, you're going to see a chat and Q&A box. You can pop questions into the Q&A, and if you'd like to let me know who those questions are for, then I can direct those questions to the right person. If it's just a generic question, I'll ask it to the whole group. I usually wait until it makes sense to ask people questions, so I'm not going to interrupt anyone presenting, but I will make sure that everyone's questions get answered. If we run out of time before we get to all the questions, then please be sure to send your questions via email. Everyone's emails should be provided on the final slide. So can somebody let me know right now if you can hear me okay just by typing into that Q&A box?
I can hear you fine, so we might have shy audience syndrome.
No, there we go. Hey, Adam, thanks very much. Nice to see you. Always a pleasure. What else have we got on here? Wonderful. All right. Looks like we don't have any problems with the audio today. So before we begin the presentation, I want to just provide everyone with a disclaimer. These presentations are intended for educational purposes only, and they don't replace independent professional judgment. Statements of fact and opinions expressed here today are those of the participants individually. They do not represent the opinion or position of their employers or any certifying bodies, and nothing presented here today should be considered legal or financial advice. You may also be watching this program on demand, so please consider that the information in this presentation hasn't been changed or updated since the original publication in 2022. So with that in mind, let's get into it today. So I'm going to introduce you to all of our presenters today. Ian, since you're not on mute, do you want to go ahead and introduce yourself first?
Yeah, sure. Hey, everyone, I'm Ian. As Carrie mentioned, I'm one half of Richardson and Richardson and CEO over at Managed Sales Pros. And Carrie and I are pleased to have you all here and excited to dive into this topic.
Wonderful. Jay.
Hi, I'm Jay Cook with AAI Financial Group. We are commercial loan brokers, so we will work with businesses to help them find the right lender for their situation.
And Chris.
Good morning, everyone. My name is Christopher Vollmond-Carstens, or CVC. I am the Vice President of Corporate Development at Ntiva. That essentially means I'm responsible for all of our M&A activity at the business. Ntiva is a managed IT services provider focused on serving the SMB market, and really excited to be here for another session with Ian and Carrie.
Thanks very much, everyone. Always a pleasure to work with you guys. I appreciate y'all holding down the fort while I practiced my surfing in Mexico. It's nice to be back at work. Today, we're talking about preparing to sell your business, presenting the documentation that tells the right story. Now, you'll notice there are handouts available. If you look again on the right-hand side, you'll see 2 different handouts that we have available for you today. One is a business acquisition questionnaire, and the other is a projection worksheet. Both of those pieces of documentation have been provided by Jay to help businesses prepare for the conversations that they want to have with either lenders or potential buyers. So you can download those at will. If you're watching this on demand, you won't be able to download the documentation. So please go ahead and email connect@rnr.consulting if you'd like a copy of either of those handouts in the future. So the first thing that somebody's going to want to know when you're transacting is, why are you selling your business? There are 4 key things that we identified in the conversations that we had leading up to this series. And those things were honesty, clarity, what your future plans are, and whether you're going to stay or go after the transaction. So Jay, do you want to talk a little bit about why those questions are going to be asked and what people are looking for? Like, what answers are the ones that you want to avoid?
Sure. Anytime you sell a business, one of the questions that's going to be asked by a buyer is why are you selling? Important for the buyer to know that. If you're selling because there's something going dramatically wrong with the business and you can't seem to get it to work, that might be a warning sign to the buyer that it isn't the right company to buy. The answer doesn't necessarily have to be complex or lengthy. We worked with a client who was selling their business. It was a husband and wife team running a business, and the reason for the sale was divorce. And I don't know there was much more needed to talk about than that. But understanding yourself and why you're selling the business and why you want to get out at this time is important, and it's going to be important for that buyer to know that, maybe understand it and have a positive spin for it. If you want to retire, or you've been doing it for a certain amount of time and you're just ready to move on to something else, those are great answers, but always good for the buyer to understand that. Hopefully
Chris,
that's
you guys
answered
have,
questions.
Sorry, Jay. Chris, you guys have obviously transacted on several MSPs over the last few years. When you're asking that question at the beginning of the process, tell me a little bit about what you're hoping to learn from the MSP that wants to sell.
Yeah, so for us, I think it's really about clarity of intention. Look, it doesn't, at the end of the day, it doesn't matter a tremendous amount whether the seller is interested to go immediately sit on their boat and enjoy their retirement, or they're interested in just a finite time period with the combined business to facilitate transition, or they're in it for the long haul. I think the most important thing is just being able to be honest and upfront about what it is that your true intentions are, and then you can plan for that accordingly as you engage with prospective buyers. The most frustrating thing can be is if you are, thinking that you're going to say all the right things and attract the most number of buyers out there, and then as you move down through the process, your true feelings or your true intentions reveal themselves. That can be incredibly frustrating for a prospective buyer, because they feel as though they maybe have been led on by you, and then it's also frustrating for you because you're not, being able to establish that form of trust and relationship and rapport with ultimately a partner who is likely going to be paying you a hefty sum of money and potentially also be your future place of employment. And so I think that's very important. And I think it's important to think about, not just kind of what you hope to get out of the transaction itself or the sale itself, but also think about, what it is that you're really after from a, professional goals perspective or life goals perspective. Is there certain areas of the business that you find most rewarding or enjoyable and would like to focus on that, and perhaps remove some of the burden of doing everything off of your plate? That's also important to be very clear about as well. And look, we fully also recognize that sometimes these thoughts about what you would like to do can evolve or change over time, even during the sort of get to know you process and diligence process. We just hope that it doesn't sort of flip 180. But I think as long as the clarity is out there, then it allows for more sort of fruitful conversation with a prospective buyer, so you can really find someone that can align most closely with what your goals are, and kind of use that as the foundation for hopefully a great outcome in the sale of the business, and sort of following thereafter with for your employees, for your clients, and frankly for yourself.
So if you're looking to acquire another business, Chris, what are you hoping the owner is going to do? Do you want them to stay engaged with Ntiva? Do you want to just write them a check and kick them out the door? What is your preferred engagement at this time?
Yeah. So for us, it ultimately depends on what the intentions is for the owner. If the owner is interested to go sit on their boat straight afterwards, we do hope that there are individuals within the business who have been very active in the management and running of that business, sort of help facilitate that transition. That's hugely beneficial. If there's no one really in that position to do so, then you're going to have to be thinking about adverse consequences to sort of the maximum value for your business, because there may be needs to kind of bring in individuals to help support and build and maintain that business in your absence, and that could be a hit towards overall value for yourself. I think the other thing to think about is that if you are coming in to the business and looking to maintain either a temporary role or even for the long term, to really carve out what it is that you're most interested in, excited about doing, and that can help sort of bring a lot of frankly insight and clarity to kind of figure out how to best position the business within the larger organization that you're seeking to join.
So Jay, if somebody's preparing to sell their business, what can they do, say a year or 2 years before they start looking for a buyer that would enable them to leave the business? What would a buyer be looking for?
Well, a lot of things to do to start preparing. And I love the way you phrased the question, a year or two in advance. I think it's important if you're considering selling your business to have a time frame in mind, and having a few years in order to prepare is a good idea. One reason is you want to make sure that your financials are in order, and what that means is a lot of buyers and the lender for the buyer are going to be looking at tax returns. Your tax advisor may be doing things in order to lower your income, in order to lower your tax burden. But the buyer is going to want to see cash flow. So if you've been running certain things through the business that maybe aren't necessarily technically business expenses, I've seen owners run their college students' child's car through the business, expenses for that. So it's not always. Sometimes personal stuff gets into the business expenses on the tax return. The cleaner you can make your financials and the better shape that they look on the tax returns, even if it means paying higher taxes, it's going to present better to that buyer. So that would be one of the places to start, is to really look at your financials and make sure that they are clean, or at least identify items that wouldn't be part of your financials if a new person took over. And some of those things might be actual, legitimate expenses. If you're paying for your health insurance through the business, but then you're no longer to be with the business, that is an expense that can be taken out when you adjust the cash flows. So. Other things to prepare, start thinking about what's really being sold and what things have value. So obviously is there equipment? Is there a process? Are there intangibles, patents of some sort, software that has value? Is it the client list that has value? Is there real estate, and are you still selling the real estate along with the business or not? So knowing what you're selling and how you're going to approach that and what value those items have is going to be important in your preparation.
I needed that hot tub. It is a corporate hot tub. Clients sit in that hot tub all the time.
If I could just add something to that, I think Jay makes a very valid point about having that sort of insight to the types of expenses that are either business related or not. I can speak from Ntiva's perspective. As long as there's an identification of what those types of expenses are, they can be kind of adjusted at when we look at what a go forward look at the financials might look like. I think the other thing to be mindful of, and thinking in the lines of that 1 to 2 years out of preparation, is that as you do think about the financials itself, making sure that you're providing enough granularity to the different types of revenue and cost streams that you do have for your business. That can be very helpful to allow not only yourself but also buyers visibility to the performance of the business and the certain units within it. You don't want to just have like a single line item that is revenue. In this business, in the MSP world, the recurring revenue is of dramatically more value than other work streams like professional services, procurement, and the like. And so being able to separate out your recurring revenue streams versus your non-recurring revenue streams is incredibly valuable. In addition, I would say from a cost perspective, being able to understand what your true gross margins look like for your business is also insightful. And then frankly, the ability to understand with a certain level of granularity the different types of operating expenses that the business incurs, all that sort of visibility insight is of tremendous value to a buyer to help them quickly get an understanding of the financial performance of your business and frankly, the trend in that performance.
So are there people that would specialize in preparing your, like, let's say a company like mine where we've just been running QuickBooks the whole time we've been in existence. We have somebody that prepares our year end. We outsource our payroll. Who do I talk to when it's time to sell? Who's going to make my books? Talk to the buyer or the lender or whoever is going to evaluate what they're going to offer me for my business.
Well, go ahead, Chris.
Oh, no, I was just going to say, I think in that sort of regard, I think you want to start to investigate, again, sort of in advance, individuals who can help provide that sort of connectivity into the marketplace, similar to someone like Jay or others, whether it's, a business broker, an informed lawyer, even informed, accountants or bookkeepers that have, some semblance of understanding of who's out there operating in the market. Just being able to get in touch with individuals like that who can provide a broader perspective that can be of tremendous value because, you've obviously been very focused on building, growing, and running your business, but being able to have that sort of outside perspective can be helpful to make sure that you're positioning yourself well as you seek to go through hopefully what will be a very successful sale.
And are there any alarm bells that'll be triggered by the fact that, my books were a mess for 7 years and the last 2, they've been immaculate?
I mean, if it's a night and day switch like that, maybe that's a little interesting to dig into to better understand. But I can certainly see how if someone is looking to best position themselves for a sale, then being able to kind of get everything in order makes sense. So I don't see that as sort of anything that immediately a red flag. I guess in doing so, it does bring some comfort to the situation in that you've engaged with an outside provider who can provide you that that perspective and visibility to kind of bring your books up to snuff. So I think on the whole, it's a net positive. But I didn't know if Jay had any particular perspective there, knowing he's quite close to that sort of experience.
Yeah, well, I agree with everything Chris has said so far. It's important to engage a variety of people when you're looking to sell your business. A CPA would be an excellent resource if you don't already have one. I think most people probably do if they're filing tax returns for the business. Start working with your CPA early. And your question about for the last 2 years the books have looked great, but the year before that didn't, or even a shorter time period than that with good looking books. I think as long as you have documentation to show, here's what we did, here's why this expense was what it was, bring up from QuickBooks. Look, it's right there. There's the entry. A lot of the CPAs will be able to utilize that and back that out. There are also business valuation experts out there. The lender for the buyer is going to want to engage their own, but you may want to engage one yourself prior to looking at the sale just to see, is the business really valued where I think it is? Am I within a certain range, am I close? And a lot of business owners may not be. But going through that business valuation process, even the companies that do that can take your documentation. Okay, my expenses aren't really correct because I ran these things through it. Here's the documentation that supports that. They're willing to work with that and back those items out in order to get to an accurate cash flow for operations.
All right, and next I'm going to ask Ian some questions. So Ian, is someone who transacted on their MSP recently, what were your considerations when you were deciding who you were going to exit to, how you were going to exit, and what were your emotional considerations and your concerns?
Yeah, so a lot to unpack there. There's the obvious consideration is always balancing is, the what's in it for me conversation, the financial impact on the liquidation of equity in the business. And what I had to balance that with, which, and in every conversation I've had with every entrepreneur who's also considering selling their business right now, is that's one side of a scale. And the other side of the scale is what's the impact to my team, my customer base, the legacy question portion. But everyone who I've spoken with has a very significant concern, and so did I, around, hey, are my customers going to be taken care of, and is my team going to be taken care of? Because the customers and the team are what enabled the business to grow, which is now giving me a payout. There's a very real emotional toll that happens throughout the process of selling your company, which is the easiest way I know how to describe it is a 40-mile march. Every day is a slog, and every day it gets harder and harder and harder to keep moving forward. So you have to, the thing that gave me comfort was remembering that this is a marathon, not a sprint. And 26.2 miles is an accurate descriptor of how long you're going to be running down the sale path. Even if it's only 90 days, that's a long 90 days. So some of the big considerations was what is the best path for my company, for my team, for my customers, that will also still meet my financial goals. And in my case, I sold to a family member, my brother, who had been involved in the business from the start, but had never wanted to sign on the paper. He didn't want to take liability for loans and for debt financing. He didn't want to be responsible for paying the taxes. So he preferred to have a higher salary and no equity at the start. And so he and I always had a gentleman's accord of, hey, if I'm thinking about selling, I'll talk to you first. And if we can come up with a strategy that will work for both of us, then I'll happily sell to you. And I had that conversation. He said, yeah, no, I'd be interested in doing it. So looking inward is a really good opportunity. Looking to private equity is a really good opportunity. There were some private equity partners that I had conversations with, especially from the concept of, hey, I'm thinking about doing this. And I shot straight with those partners. I'd known them for 5-6 years and said, hey, I'm thinking about selling to my brother, but would you mind taking a look at some numbers and let me know what it's worth for you? That's a good double check on your valuation and financing, because private equity partners they're professionals. These are professional buyers. So they can give you a reality check, whether you're too high or maybe whether you're too low. And it doesn't make much sense to sell your organization for a couple $1 million to your team or parts of your team when a private equity partner might offer you 3 to 4. You're kind of robbing yourself and your family of that financial payout. So it's a good thing to have conversations with multiple buyers and make a pro-con list of what the outcomes might be.
Thanks. All right, so moving on to some more of the details around getting ready for an exit. What are you going to need to provide or present to a potential buyer at the beginning of the process. So before there's an LOI, before there's even a price discussed, what are you going to have to offer up to even interest somebody in talking about buying your business?
Sure, I can start there. I mean, for us, we have a fairly standardized approach to this that is sort of minimal burden on the seller, while at the same time gives us enough insight to kind of start understanding whether this is a ballpark conversation to keep having and ask for more information as to keep moving forward towards a letter of intent. But for us, it kind of covers on three things. Sort of first is a monthly look at financials over the last 2 years or so we can understand trends, performance of the business. Second has to do with clients and the type of MRR that's being generated by each of those clients, certainly on a no names basis at this early stage of the game. And then the third piece of it, and I guess on the client side too, it helps to understand any kind of client concentration that an MSP might be having with respect to their client base. And the third piece has to do with an understanding on the organization, the team, the employees, not just the structure, but then kind of also the compensation expense that is related to that employee base. That's typically your largest expense in the business, and being able to have visibility and insights to each of those three buckets of items, which are generally pretty quick and easy to produce, kind of out of QuickBooks or ConnectWise. That can help us start to have that ballpark conversation around, the EBITDA of your business, appropriate multiples to attach to that EBITDA performance, and then start thinking about the structural elements of the transaction, cash, earnout, rollover equity, whatever might be involved there. And then at least for us, look, dollars and cents are clearly very important, but during the process, from kind of first conversation up through the point of letter intent, it's really an opportunity to get to know each other, not just a buyer looking to get to know the seller, but also frankly the seller to get to know the buyer, and so that we can understand those motivations, intentions, et cetera, those goals that we spoke about at the top of the call. And then that really helps to sort of bring some of those related business points, future roles, opportunities, et cetera, into the fold, so that all that can get captured and kind of documented out, frankly, in a letter of intent, in addition to that bedrock foundation of dollars and cents value structure. So that's sort of how we, at least from an Ntiva perspective, try to be as wholesome and holistic, as it relates to putting forth a letter intent. So it's sort of everything's on the table. We can be as well informed from both sides of the table getting into that stage of the game.
Right. So Jay, when should a business owner start working on that documentation? I know, is it a year out? Is it 2 years out? Is it 6 months out? Like how will they best position themselves for success?
For the documentation that Chris is asking,
aside from tax returns, which obviously we can't.
Yeah, a lot of that would be just, when you decide you're going to start looking, you're going to start considering selling that business, and let's just call it 2 years out. That's like, when you really need to start documenting and making sure you've got controls in place and financials in place, and you're kind of building that package as you go the whole time, so that once you're ready to start committing to the sale and start engaging in people who are going to assist you in that selling process, it's already there and it's already built up. Things like the monthly financials and the breakdown of the the sales process, things that Chris had mentioned. I would add just a couple of things to those items, which are minor details. One is to make sure that you've thought about the physical assets, the intangible assets, what's really included in that sale, to make sure that You may have a business where you want to sell off this part of the business, but certain things you want to keep. Maybe there's a patent, maybe there's certain software you developed that aren't going to be part of the sale. Maybe you operate out of a building that you own, and is the building going to be part of the sale, or are you going to hold on to the building and lease it back to whoever buys it, or however that might work. So the asset list, I guess, of what's included in that sale is an important thing to consider and have ready as part of your documentation.
All right, and then as far as bringing in a business valuation specialist or a CPA or somebody that's going to assist you in the process, do you bring that person in before someone expresses interest, or is that an expense that you don't need until somebody puts their hand up?
I think that depends on you and you as running your business. I don't think it would hurt. It can be expensive, but at least, if you go through the expense of bringing a business valuation expert in, you're going to get a really good understanding of specifically what the value of that business is. If you're saying, well, I think it's worth 1.2 million because, or I think it's worth 10 million because, are you looking at it the way that the market would look at it? Are you looking at it the way the buyer would look at it? The lender is going to be having their own business valuation expert take a look at it. So is your expectation the same as how they're going to be viewing it on a cash flow basis? So, if I were selling my business, I'd probably want to engage a valuation expert so I can make sure, hey, if I need X amount out of this business in order to do what I want to do, retire, be on the boat, whatever it may be, am I going to get that out of the business? Is that realistic? There's a variety of other groups that you might want to engage as well. Your CPA may have the ability to do that valuation for you. You'll want to talk to other groups like your personal financial advisor. They might help you know where you need to be on this sale in order to do the things that you want to do. Another group that I would talk to is your customers. You may not want to tell them you're selling, but you might want to say, what do you think of the business? What do you think of our products? Give me some honest feedback on how we're doing, because your buyers are certainly going to, the buyers of your business are certainly going to talk to your customers as well. And if you have an inflated idea of what your customers think of you, you might have an inflated opinion of the value of your business as well.
I wouldn't have thought about CSAT as being an important component of sale of the transaction strategy. So that's something everyone should take back and noodle on for a little while. Are your customers as happy as you think they are? And if you're not checking in with them annually to figure that out from a sales and marketing perspective, you should be doing that anyway. And if you're thinking about selling your business in the next couple of years, as Jay's just said, making sure who loves you and who's leaving you before you are about to transact, because your earnout will be tied to client retention. Now,
one other thing on there around customer retention, customer retention is one half and customer acquisition's the other. A lot of businesses, and mine included, develop off of word of mouth referral and entrepreneurial instinct and grit. You're able to walk into a room, you can walk around and chat with 10 people, and suddenly some sort of opportunity drops out of the sky because you print rainbows. But someone coming in, or a group of people coming in and buying your business, may have a different skill set and might not necessarily have that. So even if you haven't needed marketing and a sales process, even if you've been able to grow it without it, you want to get those systems and processes in place and have enough of a run rate to show that it works, that this is a system that doesn't need Ian Richardson, the CEO of Doberman, to run. It can be transferable and it's a repeatable process. So, and it doesn't have to be TV ads or cold calling or whatever. The tactics are irrelevant. It has to be a system that you could plug someone else into. So if you're going to market through networking and going and having coffee dates, that's fine. Document it out and show how it can happen so that when Tom Jones buys your business, Tom can plug in and run that process himself and be able to develop new leads and opportunities versus hoping and praying that your existing relationships will transfer over at the point of transaction.
So Chris, this is a question for you. How much does the process documentation that a company has at the time of acquisition impact the purchase price? So I've got 3 million in revenue. My EBIT is where it should be, but everything's a mess. My documentation's a mess. We kind of like brute forced our way to 3 million versus a company that's got, a nicely organized set of process documentation up in a platform like Confluence.
Yeah, so I mean, I think that that element there that you're kind of speaking to was what I'll call an operational maturity of the business. And the better that you are able to demonstrate that maturity, the more willing that a prospective buyer will be to pay a premium for your business, because they know that the work that they will have to undertake in order to kind of absorb your business, your employees, your clients, your processes into theirs is going to be much more streamlined than if things are frankly a hot mess. If that's the case, then they recognize the amount of time, energy, and money that it will take to kind of get things cleaned up. And because they recognize that, frankly, they're going to ding you for that in the valuation of the business. I think they can also sort of speak to sort of the element that Jay was touching on earlier about being able to, bring your business to a business valuation expert and kind of get that gut check initially, or as you're progressing through your readiness process to get a sense and a realistic sense of just how valuable your business is versus where you think it is. So I think that's an important thing to be mindful of as well.
The one thing that I learned through the course of this series that I didn't know previously, and might be of interest to anyone who didn't attend previous sessions, is that if you can run your business at 40% EBITDA and the buyer runs their business at 18% EBITDA, they are not going to value you at your 40% because they're not going to be able to have a run rate that's similar to your small business. So something to think about when you're considering how much your business is worth is, what could an organization run it at versus what you're running it at right now? So that's maybe a question to have at the very beginning, because if you're going into a conversation thinking you're going to get a 6 times multiple of 40 and you're going to get a 6 times multiple of 18, your expectations and reality are going to be sorely disjointed. So Jay, this final one is all you. Tell us about tax strategy. Tell us what we should be doing when we sell our business so that we pay less tax on that transaction.
Oh, I am I'm not a tax expert and not able to give tax advice. I apologize. So that's
well, I'm not giving the tax advice.
So on tax, kind of to respin the question, and Jay, you hit on this earlier. It's common to have that, and again, I'm not an accountant, not tax advice, not legal advice here, but it's important to have the discussion and say, hey, in 2 years, I'm thinking about selling the company. What do we need to do to prepare for that? Because you may need to raise a common theme in small business is low W-2 payroll and distributions, maybe higher rents to yourself because you can avoid certain tax structures. You're going to want to get your rents in line with market rates instead of inflated rates. And you're going to want to have enough W-2 salary allocated towards yourself. Maybe it's split amongst you and a spouse or whatever, but you want to have enough of a bucket there to paint a picture of, hey, this is real profit versus adjusted profit. Another thing that Jay mentioned was the add backs. it's infinitely easier to have a conversation around one or no add backs versus trying to go through a list of 10 or 15. So it's better to pay a little bit more tax now throughout the process than to have to try to sort out all of those add backs and potentially having some of them not be okay or not be honored by the buyer. It's easier to just say, hey, I'm gonna take a higher salary and pay for this out of my pocket in post-tax dollars. So you pay a little bit more now over a couple of years than to get to the selling table and not be able to close the deal because your books are a mess. So better to have 100% of whatever's at the end of that rainbow than to hey, I managed to save, I didn't have to pay tax on this $5,000 expense or this $10,000 expense. Just pay the tax on it and be able to sell for the whatever million, 2 million, 10 million that you have waiting at the end of the rainbow.
Thank you, Ian. I misunderstood the question and thought you meant the taxation on the sale itself. And there's different ways to organize the sale, asset sale versus equity sale, that sort of thing. So apologize, I misunderstood the question there.
Always go for the equity sale.
I would also just add to sort of this point that Ian was making, is that I think it's important. I think I may have made this observation earlier in today's conversation. Being able to associate yourself and surround yourself with kind of transaction familiar advisors, whether it's on the financial side like a CPA or a lawyer, others who can provide you with that insight and guidance and perspective that will sort of inform you on what's reasonable, appropriate to ask for, what is out of bounds or out of market for a type of transaction like yours. I think those are immensely valuable counselors, frankly, to have at your side, because you will be more than likely engaging with someone who may be a more sophisticated, financial individual than yourselves, or much more transaction savvy than yourselves, and in order to sort of ensure that things are sort of held on equal balance, it behooves you to have someone who is very knowledgeable in the space, so that you're kind of all up on the same level, up on the same par. Because the last thing that you want to have happen is you're moving your way through a transaction process and everything's going swimmingly, and you seem to be stuck on something that seems very important to you, that in point of fact is the ask is wildly unusual or wildly out of market, but you don't have an advisor to kind of counsel you and say, like, hey, what you're asking for is a bit out of the norm, so instead of pushing on this particular point, maybe we ask about something else that ultimately gets you to where you need to be, is much more reasonable to the buyer, and I guess at the end of the day, gets you to a successful outcome of a sale where all parties are excited and enthusiastic about going forward.
All right, so the core of our presentation today is around what to expect in due diligence, which I think if you've never gone through the process of selling a business is a big mystery for a lot of people. So Chris, tell me a little bit about the due diligence process when you first engage with a company and you're considering purchasing that MSP. What are you going to ask them for? And what are you looking for?
Yeah, so I think right off the bat, it's important to acknowledge, and I think it was said earlier, look, the diligence process can be a slog. It can be painful, it can be annoying, it has its own twists and turns and unexpected events. It is, it has the potential to be a painful process if you are not adequately prepared. But I think the important thing to understand is that we as a buyer or a buyer coming in, they're trying to learn about your business in as quickly a time frame as possible, and to do so learning from someone who has literally done this for a very long period of time, whether it's 5 years, 10 years, 15, 20 years. They are the most knowledgeable person about the business, and the buyer could never imagine to know as much as you do as the seller. So they are trying to ask the most reasonable number of smart, insightful questions to learn about the business as quickly as possible, because they would like to move through this diligence process in as efficient a manner as possible. Because if it drags on too long, look, you're also trying to run your business while you're trying to do this as well. You don't want to experience deal fatigue as you go through it. You can lose momentum, lose interest on both sides through it. So if you can sprint, if you can push, if you can sort of deal with that short-term uncomfortableness for 60 days or 90 days to get you to that desired outcome, that's where you want to get to. I think that to sort of answer more specifically on the question that Carrie posed, it's really about building a more detailed understanding of some of those requests that had come in way back before the LOI was signed, way back when you're still learning about the business. So it has to do with financials, your client profile, your team profile, prospects of the business, understanding kind of how you went about the growth and development, expansion of your client base, how you dealt with client churn or employee churn, or sort of the overall growth or expansion of your business, certain business lines, et cetera. Just trying to understand the story of your business so that they can communicate it around through the executive or leadership teams of the buyer itself, as well as communicate that and provide evidence to that with respect to any lenders that they've involved as part of the process. So that's what we're trying to get out. And I think the last thing that I would mention is, I know that in some cases, sellers can be very sensitive about the knowledge dissemination of, oh gosh, I'm going through a sale process. What are my employees going to think? That's ultimately a personal decision to be thinking about, but we find it incredibly valuable if we're able to engage not just with the primary seller or primary owner of the business, but also that trusted cohort of employees who are most knowledgeable about the financial side, most knowledgeable about the clients, most knowledgeable about the sales process or operational efficiencies, whatever it might be. That can really bring a more fulsome understanding and perspective of the overall business to, again, speed up our learning as the prospective buyer. And so that can be advantageous to go through. But ultimately, how wide that circle is sort of a personal decision for the seller to consider, but one that we see as being very valuable should you be able to expand that out into your trusted cohort of colleagues and partners.
So I have some interesting poll results to share with everyone. I'm not sure if everyone can see the poll on the right-hand side or if that's something that only the presenters can see for the recording, but 51% of the people on the webinar today say that if they sold their business today, they could meet their retirement goals. But only 1% of the people on the call today plan to sell their business within the next year. I find that really interesting. And I'd like to know, Chris, Ian, Jay, 80% of the people on the call today say that they have clearly defined processes in their business that would make it easy for a buyer to run the business upon exit. In your experience, does 80% of the market have their shit together enough to sell their business right now?
I mean, that is a very, very confident group. I would say maybe a bit of dose of reality to that. I think there's always opportunities to learn, improve, and grow. And so I'd say that, like, if you think you've got your act together, that's phenomenal. That's a great place to be. But I would say that I think there's always opportunity to improve from there. And I think even going through a sale process, you can see opportunities about thinking about how you can do things a little bit differently to sort of better the overall experience for your clients or for your employees, frankly, for yourself. So I love the enthusiasm. Hopefully it proves out, because frankly, it'd make my life a little bit easier.
So 5% of the people on the webinar today are planning to sell their business within the next year. And 22% are planning to sell within the next 5. So it looks like there's going to be a lot of M&A activity in the IT channel in the next 5 years. Super excited to watch that unfold.
Yeah, to go back to the previous point, if everyone's got their processes dialed in and doesn't mind sharing them, reach out to me, because I'm always interested in looking at processes, and I'd welcome the exposure and opportunity to chat through that. I've been finding on the Richardson and Richardson end, this is a new business with new offers and new everything, and most of my time is spent saying, okay, I'd better process this out. I'd better write this down. And every time I meet with someone, every time we perform a service, I go, oh, that needs a procedure. Oh, that needs a process. Oh, I missed this. I missed that. I missed this part. I missed that part. So way to go for all of you out there in the audience. That's awesome that there's been a focus on it. After meeting with a trusted advisor in my sphere around a different business that I'm involved in the sale process of, the number one thing he said was, it's good that you have all this stuff written down, because without it, you won't be able to get to a transaction. So being able to paint that picture through your processes and through SOPs is a really good place to be standing at and starting from. So keep it up, keep the focus there.
Yeah, remember, if somebody wins the lottery and doesn't come into work the next day, and they are the single source of truth in your business, you're really going to struggle to run it. So make sure that it's written down somewhere. Make sure that your institutional knowledge isn't living in the brains of the people that are working for you. You know, get that information into a central repository where you can access it and reference it and train to it. If you lose somebody, you could lose a key member of the staff during the transaction, and if their knowledge goes with them, your transaction is suddenly worth significantly less. So,
well,
Jay,
this is losing a key employee, the owner. It's really important, I think, for the owners out there to think about what they do, what their functions are, and are those functions documented as far as procedures. As the owner, it's likely your stuff that you do that doesn't have the procedures written down, and someone trying to come in and take over the business and they've just bought it, they might have procedures for everybody else, but not for what you have done.
To run managed sales pros, you have to be able to look at discounted airline tickets at least 1 hour every day and figure out what hotel you want to stay in. And also, you get your credit card taken away when you hire a CEO. So that's the process.
Well, all the contracts should be reviewed for what happens in the event of a sale.
All right, so Jay, now we've got a whole bunch of due diligence action items. What are you going to have to gather up? We've got tax returns. We talked about a couple of other things, processes.
Yeah. So there's all kinds of things that are good to have on hand and ready to go when you're looking at selling a business. Some of the more important things are going to be tax returns, as well as year-to-date financials. Those are going to be key for whoever's looking at your business or for whoever's trying to help you sell that business.
Contracts you mentioned.
Contracts. Yep. Have all of your contracts with vendors, contracts with customers, contracts with financial institutions if you have debt. Whatever contracts you may have, make sure you've reviewed them, know what happens in the case of a sale, and have those ready for due diligence. As we talked about before, identify what specific things are being sold with the business. Take a look at your accounts receivable and accounts payable. First of all, are they in shape? Do you have receivables that have been sitting out there longer than 120 days? And do you really know what you're doing with them? Are they really expected anymore? Do you need to clean it up? And how are receivables and payables going to be split on the date of the sale? Right? Have you thought that through? Does it stay with the business? Do you get all of the receivables? How does that work? Have a brief history of the business and why it's successful prepared. Whoever's assisting you in finding a buyer will find that useful to have. Buyers are going to probably need some sort of forecast for what they're going to do with the business, especially if they're getting SBA financing. We work with a lot of buyers that go through SBA in order to purchase businesses. The SBA is going to require at a minimum 12 months of monthly forecasts and additional 2 years of annual forecasts. If you can have something like that prepared so that the buyer is not working from a blank spreadsheet, that would really help their process move along. Obviously, they're going to do some things differently. They'll have some different things to put in there, but having your thoughts on the future financials of the company would be helpful to them moving forward. It's the same with a business plan. An SBA is going to require a borrower to have a business plan when they're buying a business. Having a business plan prepared, even though you won't be there, would be extremely helpful, not only for the buyer to understand the business, but for them to make changes to it to make it their own for when it's their turn to go to a lender and get support for their purchase. Understanding the key employees, job descriptions of those employees, and an estimate of who might be staying and who might be going if the business gets sold. That would be a really good start of things to have in hand when you're getting ready for the sale process.
All right.
Chris, do you have any additional items?
I have many, but I think it ultimately depends on, I think what Jay was speaking to, sort of those core sort of foundational type documents. I think anything related to your employees' payroll reports, evidences of taxes paid, not just payroll taxes, but state and local taxes, et cetera, just so that you're registered up and filing in the right places. That's important because as part of diligence effort, depending on the size of the business, the buyer may do a tax diligence review, have an outside advisor do that. And if it looks as though there are potential areas of tax shortfall that could be at risk, you could likely see, tax specific escrows put in place at the time of the transaction, which would reduce your upfront consideration, amount of cash that you receive on, just to handle any potential future tax liability. So being sort of up and current and present on those things is also very important. And then also, depending on the business you're coming into and what's the intention from an integration perspective post-close, there are a whole host of operationally minded documents, questions, et cetera, that would likely come from that. But ultimately, that's the determination of what the buyer is planning to do with the business, with the people, with the clients, post sale. So there's a wide spectrum of sort of possible items that come to bear. It ultimately just depends on sort of what's the shakeout post close.
Okay, we have about 2.5 minutes left. And the one thing I'd like Jay or Chris to explain, what's the difference between an equity transaction and an asset transaction?
Jay, you want to take that one?
In brief, so let's say you've got a
you have 1.5 minutes.
If you've got a business entity like a corporation or an LLC, and you're selling the business or the equity, they're buying the business, they're buying the paperwork, they're buying the entity itself. So all of the debt and everything else goes with that. If it's an asset sale, they're buying specific pieces like inventory, equipment, receivables, and real estate maybe. So you're just buying the assets. The debts don't travel with it. Some of the contracts don't travel with it. That's in a nutshell the difference.
And that would be clearly outlined at the time of transaction. I'm keeping this and I'm selling. So for example, when I had an asset transaction, I sold all of my contracts, but I kept all of my intellectual property.
Yeah, I think that's correct. And I think, with either transaction structure, the buyer may have a preference, seller might have a preference, and then for each of them, there are tax considerations to be mindful of that should also, start that conversation on it earlier rather than later, just so again, there are no surprises coming down the pipe.
And I think that if you guys want to learn anything else about M&A, you're going to have to show up next month because we are down to our final minute. And I want to make sure that anybody that wants to contact anyone that was on the webinar today has the ability to do so. So here we've got everybody's websites listed, and there are contact forms on everyone's site. So you're welcome to go over and connect directly with Jay if you're interested in working with someone to transact on your business. Connect with Chris if you're hoping to have your business acquired by an organization like Ntiva. And Chris, if you want to just like quickly let people know what kinds of businesses Ntiva is looking for, so you don't get 50 people emailing you who just really aren't in your sweet spot.
Yeah, so for us, we're focused on managed IT services providers that typically target the SMB client space with high degrees of recurring revenue, 65, 70+% of MRR, and adjusted EBITDA, approaching $1 million or $1 million plus. That's our sweet spot, and it also aligns, generally speaking, to our geographic areas of focus in the DC area, Chicago, Northeast, as well as out in Colorado. But we are looking to expand nationally. So that if you're not in one of those areas, doesn't want to dissuade you from reaching out, you're also more than welcome to reach out at mergers@ntiva.com.
Thanks very much. Ian, any final thoughts before we go?
Nope. Have a good Thursday, everyone.
Wonderful. Well, we'll see you back here on the third Thursday of next month, same time. And we will also be featuring a few other experts next month, so you won't want to miss that. Thanks for spending some time with us today. Hope the information was valuable, and we will look forward to seeing you next month.
Thanks, everyone.
Thank you.
Thanks, everyone. Have a good day.